Good morning, traders. I hope everybody can hear me. It's Cayman here. I'll be your host today. Before we start the show, just to let you know that Ryan won't be with us today. He is feeling under the weather. He's been caught by a bottle or I don't know what, but at least it's has the name Corona on it. He's feeling very tired and feverish, so we hope he's going to recover very soon. He said he may be already joining us again tomorrow, but we'll see about that. We wish him a very speedy recovery, of course. Right, let's kick off because there's plenty to talk about today, obviously, looking at the moves. But before we go into what happened over the CPI yesterday, let's go over a few headlines that came out over the course of the evening and the night. So first of all, US House voted positively towards the stopgap for the funding. So that is now going to the Senate for the vote. It should be voted, I reckon. So we are likely going to push back any or avert shutdowns right now, push it back for a few months again until the next moment where we should have some more stress again around this. There's been a bit of give and take in this program, in this stopgap bill. So perhaps not everything is really good for people who are living the stress of Ukraine or Israel or whatever. But anyway, they avert the shutdown. Let's move on from that. And already looking forward to today, speaking about the US, is we have this Biden meeting expected for tonight, 18:45 GMT. That should take place. So they're going into this meeting with a couple of expectations. US is trying to revive the military dialogue again with China. That's probably going to be the main aim. But China's agenda seems a little different because she already came out with some comments regarding Taiwan again, that they want to increase the close cooperation. They want to keep the stronghold over, or at least try to get Taiwan closer into the Chinese fold again. So not sure if we're going to have a lot of positive news coming out of this meeting. But amongst all the other stuff that is happening right now on the data front and geopolitics, it may create a wobble or two. Let's see what's going to come out of this meeting. In China, the PBOC left the MLF, the loan facility, unchanged at 2.5%. But injected another 600, is it 600 billion? Or no, 600 million, it must be, or whatever. They injected cash again overnight. And even though the Chinese yuan has strengthened a lot with the lower dollar yesterday, it does seem that we are finding some support there. But elsewhere, as I already mentioned on prior shows, the investors and banks now also starting to change their forecasts on China. And the latest one was JP Morgan increasing the growth expectations a little bit, saying that the worst may be behind us, in line with what Goldman Sachs was saying the other day. But also a few of the larger investors are starting to change their view on China. The PBOC left the fixing unchanged. I think they are just trying to stabilize the whole thing. Didn't want to weaken Chinese yuan further than where it was in those 730s, and they seemingly start to succeed with that. Now, depending on where the dollar is going to go, because this is still going to be the main driver for the rest of the week. It does look like if we get rallies again in dollar China closer to 730, it does look like this may be met with some more interest from investors, perhaps. I'll for sure have a closer look at that. Next, yeah, there's also been the reaction. Australia is hoping for the restrictions from China to be completely taken away by Christmas. So there's a bit of positive news. It was already touted yesterday. They had the comments again overnight. So now we'll have to see what China says about these relationships. But definitely, if trade blocks are taken away towards Australia, that should be somewhere good for the Australian trade numbers, and de facto the Australian dollars should take a bit of positive from that as well. Over to Japan. First of all, the Japanese tourist numbers are back to 2019 levels. So from that side, they are back to those levels. They collapsed during the pandemic, obviously, and now they are back to those levels. So from that side, it's a small positive for the yen. But then if we look at
refreshing.
But then if we look at what's happening on the GDP overnight, is we had a big setback here in the GDP numbers. So that is not really good news for a country that wants to their economy to start buzzing again with a lot of stimulus packages from the government. That doesn't look really good. So that's probably going to keep some pressure on the yen, perhaps not so much against the dollar right now, but as we can see, those yen crosses are still stubbornly going higher. The only higher number here was the deflator. It doesn't show deflator here, but this is the deflator coming in at 5.1, which is a big jump from the last reading before. So that should again tell the Bank of Japan that they are moving out of deflation, or should at least support the view that they can or should normalize relatively sooner rather than later, actually. So that is one that the Bank of Japan will have noticed, I trust. What else do we have? Yeah, the Bank of Japan also came out saying that they will cut their regular JGB buying plans. The 5 to 10 year has been reduced to 575 billion yen per tranche instead of 675 prior. The 1 to 3 years has been scaled down to 375 billion yen from 425 billion yen. That is another news for the yen, for the JGB yields. But we also know and have seen that when yields are getting closer to 1% on the 10-year JGB, that they did unscheduled buying. Sorry. So I'm not sure whether that has a really big impact on what's going to happen to those yields going further. At least the market did not really react to it, because we saw JGB yields come off together with those dollar yields as well overnight. Last line is that Kishida now is pushing for the companies, and we've already seen those unions asking for even bigger wage hikes for the next spring, which is one that the Bank of Japan is keeping a close eye on. But Kishida now is pushing for the wage growth to exceed inflation. So he is pushing for those higher pay rises, even compared to this year. So that's still one for the calendars for the next February, March, where we should start to know what's coming out of those wage negotiations. But he's really pushing, and as we know, Bank of Japan is hoping for those wages to go higher so they can start to raise interest rates. Now then, closer to home. We have seen this morning, we have seen a bit of those Chinese data coming out as well. The industrial production was better. The retail sales was better. So the picture over there in China is definitely changing a little bit. Have we seen the worst? We never know. We don't know whether there could still be some more negatives coming out. But if we look at how the ship is sailing, it is starting to look like they are turning the corner. We can start to cautiously say. We've also seen wages being high. This is still a multi-year high. This is still a multi-year high on the wages front, so that keeps the Australian dollar underpinned as well. And then we have had this whole bunch of UK, sorry, CPI and PPI data out. They came in a bit weaker on the headline. Also on the core CPI, they came in a tenth weaker, but we are still stubbornly high on those CPI numbers. There has been a few victory laps from politicians, of course, saying that they are managing to bring it down. Of course, if you start from levels of 10 or 11%, bringing it down to sub 5 or just above 5 here is, of course, causing a bit of a victory lap from those people. Those numbers are more mixed. We've seen the PPI coming down, but the RPI is also coming down, but still remaining quite stubborn there. It did not have too much of an effect on the sterling today. I think it's just keeping the Bank of England where they are really right now. So we've seen the market cutting rate forecasts, but that is more due with that inflation coming down well, globally for one. But perhaps the pendulum is swinging a little bit too far to one side right now, because some of those expectations are now starting to show half also cuts for already March, which is UBS's call, but I don't know. It's still a few months to go, but that looks a bit early to me. But anyway, sterling didn't really do that much on the back of it. Yes, cable is a bit lower, but then all the dollars, barring Aussie and Kiwi, right now are all trading a bit on the defensive ahead of the next round of US data. What else that came out? Yeah, we had those the final CPI numbers in France. We had the final CPI numbers in Italy as well for October. France, all as expected, as we've seen from other countries yesterday. Italy just a tenth lower. Euro crosses perhaps slightly on the defensive, but it didn't really move that much. Then what we just had a half an hour ago, the European industrial production is still looking very, very gloomy. At the same time, we had the EU Commission coming out with their report saying that they are also now starting to revise inflation lower, but more importantly, again, revising growth lower in the Eurozone. So the Eurozone is really not yet out of the woods. They see inflation getting back somewhere towards target in 2025, closer to targets, let's put it that way. But growth is revised weaker again. But the line that they always want to mention as well is that they don't see a recession. Okay, so they're thinking like a bit in line with what's happening in the UK. They are thinking that we are going to avoid a recession. But if you could then compare those growth numbers to the growth numbers that we had last month in the US, we still have to compare both and still have to see that the US is still outperforming. Right. What else? Okay, that's about it. Let's move on to what's really happened then yesterday. US CPI, and that was one of a hell of a move for a 0.1 reduction. Although some of the metrics which are not taken up here showed a bit of a bigger decline, but it was enough for the market, and we were already saying that something may be brewing. Market may be looking at a deeper lower CPI readings. We had already a bit of those moves on beforehand on past data in the US bond market. The equity markets holding up very well, and yesterday really was some kind of this green light for more soft landing trades, more positive risk trades, and a lower dollar. And we saw yields coming off, equities ramp higher, and the dollar really getting hammered. We were talking about those important levels. I'm going to have a look at them in a minute, but we were talking about those important levels, and just you name them, they've all been broken, barring perhaps yet bigger levels on the dollar yen. But the rest of the market really hammered the dollar on the back of those weakened numbers. So what's going to happen next? Because we are not done. We still have the PPI to come out today. It's expected to remain relatively stable. Some metrics are expected to show lower numbers than before as well. If we get a lower PPI here, it's only going to confirm what the CPI said yesterday. But I think for today, really the big number is the retail sales, because that's the next big number for the consumer, right? So we are expecting a slowdown. I have already seen some of the bank expectations saying that they expect even weaker number than this. Needless to say that if we get a weak reading on this on those retail sales today, is that the dollar is going to get another hammering, and likely same thing will happen as yesterday. Equity markets going higher, and the dollar going lower. And then I'll have a look at those yields, because we are trading around important levels there. They could get another knock on the head, those yields. So this one is really going to be a mover again today. If in turn we get better retail sales numbers, there's going to be a bit of repricing done. But again, better retail sales numbers are probably not going to weigh too much on risk either. So we'll have to be careful what happens there. We would see a bit of a revival on the US yields, probably a bit of an initial reaction, perhaps on the equity markets a tad lower and the dollar stronger. But I wouldn't bet against equity markets if actually the retail sales come in stronger. So that is a bit in line with what I've been saying over past reports, that if you get good consumer data, it's not necessarily negative for risk. Can be good for the dollar for a while, but perhaps not so much putting a top in risk, for instance. What else? Oh, we're finally going to have those oil numbers out. You remember last week we had a huge build on the API above close to 12 million barrels. Last night, where is it? It came out just another small build. So here you see that was a near 12 million barrels build. I would suppose that we are going to get 2 weeks in one. Perhaps somebody in the audience can, who knows how those reports work, can tell me if we are going to see 2 weeks in one. So we combine numbers today. It is possible. But let's see, that's the other thing coming out today. And then we have also the Empire State, which has been very volatile, but showing a bit of a negative slant of late as well. So This is already a November number, so this is going to be a bit of an interesting read as well. Bit of a kicker, perhaps, if we get good or bad numbers on those retail sales, right? And for the rest of the day, of course, a few more speakers, but really the main one then later today will likely be that meeting between Xi and Biden. Right, that's it. Let's move over to the prices, shall we? Oh, I don't know, Brian, Eastern time. It's the usual times when we are ending phase. You know, that's the time when those retail sales come out. Yeah. Dimitri, Eurocat, I will. Okay. Right. Change screen. You guys can see my. There will be 2 simultaneous releases, Rick. So skip to the other pertains to the okay. All right. So it's a combined report then. Thanks very much, Rick. Right. Yields, and let's start with the 10s. We are on channel support. This is a pretty important level, I would say. And that's probably going to hold or break over the retail sales or PPI. If they both come out weak, it's probably going to break. And this is where we are going to have to watch carefully what's going on. This is this 433, 35, 36 zone on the US 10s. The prior top, prior traffic zone, and the springboard to what happened finally up to the 5%. Okay, so keep this level in mind on the US 10s. This is probably going to be decisive if we would go and test it. Of course, if the retail sales come out really bad, the bond market having reacted like they react of late, why not even go and have a look much lower? But that would really put the dollar under tremendous pressure if that would happen. Okay, and this is around 409, and then we have even more in the 390s. But I wouldn't say, and I'm going to stick my neck out a little bit, it'd still be negative for the dollar if we get down there, but I'm not sure if we can really get much lower, or perhaps on an initial reaction a bit, yeah, but then the bond market will still keep in mind that the US Treasury is issuing a lot. So I would say here this may be good enough for the reaction after the data that we see this week. On the top side, this one I can take out. And we'll have to look what's happening in the 450s again before we can happen to the before we can have a look at what's happening around 460, 65. I would say that on any report, even if the retail sales are really good and we would have a jump back to, let's say, close to yesterday's level, I reckon in the current mood of the market, we are going to see enough people wanting to counter this move, perhaps having missed what happened yesterday because the move was so fast and thorough. I reckon that it should be enough around here. I'm not even thinking what may happen if we start to crawl back up here, if the bond market really takes the other side, which I don't think we can get over these numbers today. But we are traders and we always have to be ready for any eventuality. I would not say this is not going to happen, 99% chance, but the 1% chance that this would be happening, that the yields are going back up, that is going to be a very painful trade, in my opinion. Right. Currencies. Okay. Oh, let me first have a quick look at what happened on the differential side. And look at this. This is the sterling differentials. The funny thing is that the global bond market in the majors is still one market, and US yields having dumped. of course, the UK yields are going down less fast, but they're still going down. So we are actually still not really breaking out of levels in the differentials, where the differentials would support a much higher move in the cable. Yes, this is the rally in the cable. Yes, the US data were a bit on the weak side, but still we have to take into account what's happening on the differentials, because they are going to ultimately tell us whether we are having sustainable breaks in currencies, because a lot is still depending on differentials. And look what happened yesterday as well. We had this tightening between the euro and the US rates, but we are already correcting a little bit, and that's where the euro dollar is now stabilizing a bit. This doesn't mean that euro dollar needs to go back down. I'm just saying that those differentials are stabilizing. It's still, the US is still the bigger block, and it's still the most traded. So if we get weak data today, regardless really what happens over here, the dollar could still get a knock on the head. This is probably going to go back then to those kind of levels, but it's just saying that in the global rates market, in the global bond market, we are not seeing too much divergence between what's happening in the US, the UK, the euro, for instance, the eurozone, for instance. Okay, expectations for cuts have been brought forward to June now, real cuts, but they've been brought forward for all of them, not only the US, also for the eurozone, also for the UK. And as I said, we've already pricing some half cuts starting March in some of those instruments, but they are all moving together. So that is still barring those really big moves that we can see, because the mood for the dollar, I was saying yesterday in our chat room, it looks a little bit like a big packaging box, you know, and for the time being, those packages put inside the box are telling the people in the bond market, are telling the people in the dollar market that something is changing in the US. Okay, we are starting to see those weakening data. We are starting to sorry, we are starting to see inflation coming down, and since the US is the biggest block, that was yesterday was another little package going into that box, and that's another reason why the market is now managing long dollars, correcting long dollars, going short long dollars. You call it as you wish, but the market is repricing, in the process of repricing the dollar. And I also would like to say, don't forget that we are the 15th of November. Sometimes end of year rebalancing, some companies, some asset managers tend to start a bit early. So perhaps we are already seeing some of them having been given a green light and trading their balances. We also know that on the equity markets, and I'm going to change screen here. We also know that on the equity markets, there have been reports coming out, and that was about here, even a report yesterday, that the hedge funds have the least exposure for many months right now. I think it's since February or March or so, that they have the least exposure on equities since that time. So what happened yesterday? You got this slightly weaker CPI. Those guys are behind the curve. What happened? Bang! Another big rally. And looking at this S&P, by the way, I said about this zone here, 44.10 up to 44.60. We've really ramped through it because of lower yields, but also because of the market seeing all these developments as being very positive for the consumer, positive. A lower inflation is likely going to stop now the Fed from raising rates, although JP Morgan's diamond doesn't seem to be agreeing with that yet, because he thinks the inflation is going to come down much slower than what people expect, and that we are looking at two short-term numbers. Perhaps Mr. Diamond, but if you're watching the flow show, look at this move we've just put in a 10% move higher on the S&P in less than half a month, right? So the market doesn't really agree with you right now, and I would say the market is always right, whatever the market does. We are at the next round of levels here, okay? Just above 45. Recall, this is your move, the confirmation of the move lower that we have seen. This set in a big move lower. So people are going to watch this level as well around the 45.35 zone. So if you're trading S&P, just watch out what's happening here on the retail sales and on the PPI. If we get a good data number, perhaps some of them may say like, oh, yields are going higher. Perhaps we can make it back down to 44.5 or so. But as I already said, really good retail sales, which would be a surprise trade today, are probably going to see such kind of move on the yields. But then likely the market is going to say, but hang on a minute, good retail sales are positive, and we could gradually move up again. And I think the same could be seen in the dollar. And despite all those, this is the daily. Okay, I know it's a bit. It looks like a spaghetti chart, as Brand would say. But despite those weaker data in the EU, we have a bit of a similar situation trading now in the Eurozone as we are seeing in China. Is that the people say like, yeah, okay, all those reports are really bad out of the EU, but then in China as well, the reports are really bad, but we may be at the bottom of we may be around the worst, and perhaps things start to look up a little bit. So this is this move that we saw yesterday, very big move higher in the euro dollar, driven by US data, better risk, and better risk is always weighing on the dollar as well. As we know, this is a very popular correlation. So we were talking about those levels yesterday. 107.55 was the top, or is it 55? Call it, yeah. 107, yeah, 56, that's fine. Was the prior top, was the top of the cloud, and I said like if that goes, then we're likely going to visit higher levels. It didn't stop at the 108, where we find the 100 DMA and the 200 DMA. It just raced through, but then look at where it stopped, and let me take the cloud away. We stopped on a bit of a trend line, and if you look at this has been playing a role before. So I would say like this is your level to watch when we go into the retail sales and on the PPI, and that's 108.80, 85. That's your level, I reckon. If that goes, then we're probably talking about more dollar weakness for a while, and then we could have a look at what's happening in the 109.40, 109.60 zone, perhaps. Okay, I know there's like weekly and stuff clouds, but taking us through everything is going just to take me too much time today. So that is your level. On the downside, as I said, there's likely people who have missed this move, okay, and who are waiting now for setbacks in the dollar to get on board of things. Get a better retail sales. We may have a bit of the similar thing as in the S&P, for instance. Get down to retest those this little trend line here where we find the 100 and the 200 DMAs. If that wouldn't be enough, and we see a bigger setback because the move was so big, we could see a bigger setback. The retest of that cloud around that prior high, and it's also the 38.2 of this big move lower that we saw from July down. Maximum there, I would say that is likely a level where people would step in and say, okay, we've missed the first leg, but now let's try to get in. So 107.55 around euro dollar, I'd say max for today. But of course, that's only my opinion, right? Cable. Cable also broke through the daily cloud. We had this level marked yesterday, 124.25. It is where the bottom of the clouds roughly lies. It's around 35. It's also where we find the 200 DMA. It's also this around this prior high. So 130, 24, 30, 40. This is your first support on the cable, okay, for today. Then we have a little bit more right around 123.95. If we would have surprising numbers out of the US, like stronger PPI contrary to the CPI, stronger retail sales, and we would break through 123.95, which is already a bit of an ask, I would say today. Then we of course talk again about this big zone now around 123 figure a quarter, but in current context, in the current mood of the market, I'd say that this is perhaps a bit of a bridge too far, this level here. So I would already be looking at what's happening around 120 for the figure 123.90. Top side, we find prior highs here and prior highs and lows here, and that is around 125. 45, 50, okay? So that I think is where the next layer of resistance will come in. We have the 100 DMA around 125.10. So this zone here, 125.10, 125.45 is one that is likely going to be scrutinized. Could be a bit of, I'd say, if we get some more weakness, depending on how weak those numbers are, because the market tends perhaps to overreact a little bit after yesterday's move, especially if the market has a bit of FOMO. I'm going to keep a close eye on what's happening here, because I think this may be just enough for this leg, unless we're seeing those differentials move massively in sterling's favor. Let me keep an eye on what's. Let me look at what the euro sterling does. I think that's Ali on the euro sterling. Ali, we've retested the trendline support yesterday. Had a bit of the weakest CPI out this morning, caused a little bit of a stir, but then we're coming back to where we were before. Yeah, I mean, it's around 90. Anything 90 figure looks supportive on the euro sterling. Yeah, 87 is a bit your pivot level now, right, Brian? If we start to get below and hold below, which we couldn't over the past weeks, if we start to hold below, then we probably turning around. But for the time being, this is still looking quite supportive. So being long is probably okay for as long as we hold 86.90-ish. Okay, is that where you said? All right. Yeah, your stop loss is even very defensive. I would even say that if it breaks 86.90, it's probably already good enough to see a bit of a deeper leg lower, right? Okay, moving on. Dollar yen is finally moving. It is finally moving, and if you recall, last year, November, the move from 146 down to 127 got set in by weaker US CPI. We know that the Bank of the MOF, sorry, intervened several times during October and November, but what really kicked it off, let me just go back onto the daily, take this away, and then this is it, November. This is it. This is your US CPI number in November last year. All right. I'm not saying that history is going to repeat itself. We are in a different scenario. We are in the meantime higher on the majors. US yields. Bank of Japan is still a very, very slow mover, but just take note of it and recall sometimes history does repeat itself. Okay. Especially that we are coming from those similar kind of highs that we had in October, November in last year in in Japan. Okay, so the market may start to think, well, we may have seen the top here. Now the situation is markedly different, as we know, because yen crosses are way higher than they were over then, and I still wonder what the MOF is actually waiting for to react a bit to this trade-weighted index, because the yen is really getting hammered, and I'm not sure if they can really wait until next year's wage negotiations to act, because otherwise yen is probably going to weaken much more. Okay, back to the moves. Okay, so on the daily we have a bit of a support here coming in. That's just below 150, 149 3/4, 85, call it. The daily cloud, although, is only waiting around 108.40, and if we get a little bit closer to home, we are trading on the 4 hours, but again, I mean, it's not my preferred cloud to watch, but anyway, we are trading on the 4 hour, and if we look at here, it has been moving along this 4 hour cloud, and it has been supports in the past as well. What I think is that in line with what we saw on the daily cloud, this zone here, 148.20, 148.40, 148.80, this high here, these lows around here, this is going to be decision time if ever dollar yen comes around there. Okay, this is a level that really I'm going to pay very close attention to. Give it, call it a 50 points range, 30.80, 148, 30.80. That I think is going to be a big zone. Of course, if it comes through interventions, we can't say that we are breaking this zone because we can do this and then shoot up again to 150, because that's what happens over interventions. But if it happens in a, let's say, natural way, that is a big zone. Okay, right. Moving on. Another one that I marked yesterday clearly was the 64 on the Aussie, and actually, well, for those listening to Face, you heard it live on Face. I did buy the break. Unfortunately, already started to take profits a bit too early, because I wasn't, like probably everybody, a bit surprised about the speed and really the amplitude of the immediate move on a 0.1% miss on the CPI, but went a lot further. I had a couple of more scalps in between the move, but that was a big enough break for me. And this is now going to go going forward. Of course, this trend line is going lower, but I think the people will recall this 64 level, and that's going to be your new big support, I reckon, for as long as the US dollar remains mildly under pressure if we get the correction, but remains under pressure. And we are at the prior double top, 65.20, 25, molto importante for those who understand Italian. It's very important here, okay? If that goes, then I think we are going to talk pretty quickly about 66, the figure on the Aussie. Widening out, we are still, since February 2023, in this big move lower, okay? Probably Elliottists will say, like, okay, this was maybe it. But if you complicate things a little bit, this might only be a 3, 4, and then go back down. I hope that Greg Hay is listening in, and he can tell me that I'm talking dick shit on the Elliott waves. I don't know anything about waves, but okay, we are still overall in this larger move lower, yeah. So, and that's going to come. The resistance here is going to come in anywhere between 66.60 and 67 right now. For as long as we are in this, we can't rule out we are going to do this move and then go all the way back down, but it may take a bit of time. I think for now, really watch what's happening at 2025. On the downside, 64 3/4, 64.60, your first support zone if we fail around here, okay? But there is quite a bit to do on what's happening in the commodity sphere and on the crosses. And one of those crosses that I've been in from here, and some people in the room as well, is Aussie Canada. And with the oil only following half the move, the dollar Canada has moved lower, but he's a bit of a laggard. So we saw this Aussie Canada. You can put all the commodities Canada here. Kiwi Cat has done the same move, yeah. Aussie Canada is the one that I was in and back in. Raised up yesterday from this support zone to the resistance zone, to the prior tops, and it's also the 61.8 around 89, call it figure 5, somewhere there. And we are already starting to hold and trying to push through. There is positive news out of Australia regularly. Okay, I mean, Bullock is a little bit more aggressive than, or hawkish or undovish than Low was, but we have Aussie employment coming out overnight, so that can change the picture a little bit. But if we get a good number there, I reckon that Aussie is going to still be one of the outperformers. Okay, so this Aussie China relationship has probably something to do as well. It's all like little pieces of the puzzle coming together for the Aussie a bit better than it was before. So Aussie is one of the outperformers, testifying this Aussie Cat as well. I'm going to take a quick look at the Eurocat for our friends here. Eurocat, the level is 149 the figure. Okay, we went to test it. 149 the figure. As I said, it's a bit like on the Aussie Cat. It's a laggard. The cat is lagging. Okay, I'm not going to go long Canadian dollar versus something unless I see those oils turn around, perhaps. And you know what? I mean, the Canadian dollar is also a neighbor of the US, you know, and there's a lot of interaction between the US and Canada. So when the US dollar weakens, Canada can be a laggard versus other currencies as well. All right. So yeah, Kiwi, we are nearing resistance. Okay, on the Kiwi, 60. 55, 60, 65, okay? Kiwi data have not been very strong, but the market must have been very short Kiwi because the data in New Zealand were going a bit weaker. This is really a revenge, the Kiwi revenge move that we saw. There's probably all the shorts getting stopped out successively through all the levels. But look at this, we have done a prior high here, 60.5, here just above 60.5. Lows here, okay? Resistance here, 60, 65. We're not too far away, 25 pips. Could be tested on the retail sales, but look where we closed today around, if you want to trade Kiwi, and that's going to be important enough. If you push through, then we are talking about 61.5, yeah? If we start to cap, then I would say that it may be enough just for the Kiwi trade. And if the Kiwi stops, then I think we are going to probably find a little bit of a bottom on the Aussie Kiwi as well. Australian labor report coming out. This is going to move, okay? I wouldn't take a position before, but if you are already in a position, and if you caught perhaps the move down a bit, or if you looking for levels to enter because you are positive towards the Aussie, more positive than the Kiwi, wait for the labor report perhaps to come out. I know it can trade higher again, but if we bottom out here and then we trade higher again, I think we are going to push back up to higher levels here. Point of no return, probably 107, 20, 40, okay? If that starts to break, then it's likely going to go back down here, but this is your zone that really has to hold, but it could already hold here and start to move back up. Okay, I'm going to look for a level to possibly enter a bit of a long here, and that is time-wise all we have time for today. Trade safely. Again, we all hope that Ryan makes a speedy recovery. And I don't want to hear any horror stories tomorrow. So keep it safe, keep it tight, keep it light, and we talk again tomorrow. Thanks very much, everybody. Talk again tomorrow. Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.